G'day guys, welcome back to another Pumped on Property podcast, and I've got to say that I'm actually really pumped about this episode today for two reasons. One, we're talking about two of my favourite things, one being property and ways that we can work towards financial freedom sooner and creating a life filled with choices, but also secondly, there's a fair bit of banter, a fair bit of philosophy coming your way in this one as well, which is my equal passion. I love that stuff. I love taking abstract ideas and simplifying the journey to a life of choices and freedom.
But we really break down three different options to help you generate a passive income in the future and realize financial freedom, multi-property strategies, and we look at some compound growth rates in the long-term future, which just gets me so excited. So let's dive into it. Let's get stuck in.
So kicking things off like we always do, a lot's been going on for you in the last week. Bit of a roller coaster with one of the properties that you're trying to sell. Give us the rundown. What's been happening?
Look, my personal life has been awesome. We had a weekend away down the Goldie, surfing and training and just relaxing, which was great. But I've got a property on the market at the moment. First time I've ever sold a property, which is super fun actually. It's been a nice journey going through that process with a real estate agent. I sort of just jumped onto Google, typed in top performing real estate agents in that suburb and had a chat to the top three of them and went with the guy who I felt most aligned with. And he's been a real asset so far, which has been good, but
I thought you were going to sack him a day ago. That was 2 days ago.
Sometimes you got to put the foot down a little bit, it's more negotiation than it is anything else.
So I came into the team meeting on Monday.
Pretty wound up.
Pretty hot.
Pretty hot, because me and my wife, we've got a baby on the way, which is super exciting, and we're going to single income. She'll be on maternity leave, and we want her to be able to stay on mat leave for at least 12 months.
Yeah.
So, with our finances at the moment, the interest rates with where they're at, we just can't afford to hold the whole entire portfolio while she's on mat leave, and we just don't want that stress or pressure.
Yeah.
And it's I'm trading future wealth for, short-term comfort. And it was a bit of an ego death making that decision. And I obviously chat with you and Crystal and Haydo and all of my friends, and just is this the right decision? And it's everyone's you're only going to have kids once, and they're only going to be tiny little infant babies once. You do not want to miss out on that time, and you don't want to be in your head and just stressed out the whole time when they're young.
You're not having a Benjamin Button?
I'm not. Hopefully, that'd be sick.
I'm 5 years old.
I'd love to have a little Benjamin Button, eh? Wise little baby that I can actually full talk to and get lessons from.
This 90-year-old man that ages backwards.
But it's been heavy, hey? So the property's probably worth low to mid sevens. It's, a renovator at best, but probably more a knockdown.
Renovator's delight.
An absolute renovator's delight. Exactly what the headline is on the realestate.com ad, basically. But we had an offer at 780, which was ridiculously above market value, and it was I was a bit skeptical. I'm it just doesn't seem
too good to be true.
It did feel too good to be true, and turns out it was, but it was worth rolling the dice, but it fell over. And what happens with real estate is in that first week, that's your best chance of getting the best offer. And I accepted the best offer.
Yeah.
But there was a really good backup one there as well.
Yeah.
And then within that week, they've gone and found another property, so they're no longer interested in this one. So they're gone, and now I'm back out trying to find a new buyer. And it's only been on the market for less than 3 weeks, so it's been a really short period of time. We're getting lots of offers, just not at the number where I want it to be. And I'm super confident with, where the market's at and where that property is located, that we will get a good number for it.
Our strategy is buy below, sell above market value.
Yeah, exactly. And everyone wants a deal right now as well. So all these offers that are coming through, everyone's trying to swindle a deal. And it's I love that, because I do the exact same, but I want the best possible result, and I think we'll get there. I think we'll get
100%.
there.
It's just patience.
Yeah, it's been a bit of a bumpy ride, but we'll keep it updated. It's still unfolding, and by this time next week we'll have a good offer on the property, and we'll be able to talk about that. But Yeah, it's been fun. Hey, like I love selling property. Like you've done it how many times now?
Yeah, I think I've sold 11 of the properties I've bought.
Wow.
Man, the tax department's stoked, hey. I've paid that much tax on all these things. But yeah, like we had a really good weekend last weekend as well. Like we were down at the High Performance Surfing Institute down there in Kingscliff.
Getting humbled by a surf coach.
Yeah, well, you not so much, but definitely
Still
me.
humbling, still humbling for me. I still think I surf way better than I look.
Yeah, I was like, I really thought I could bend my knees. I was actually catching up with our mate who came down with us yesterday, who's an osteo, to get a program together to like move better for surfing. And he's like, you can fully do all the movements, man. He's like, so why don't you? And I'm like, that's a good question. But I smashed my meniscus twice in the last 3 years going back to soccer. And he's like, both times I like really didn't do much for about 10 to 12 weeks. And he's like, it might have just been your brain protecting you with that back foot. And I'm like, I'm pretty sure I was surfing like a kook before that. But I can remember bending more.
Yeah, I remember like, well, I was bodyboarding at the time, but I remember when I was a bodyboarder and you were like in your late teens, early 20s, it's like, I remember you ripping at that point, but maybe that's just because I was a bodyboarder and I couldn't surf, and I thought anybody that could stand up.
Better than this, but yeah. Anyway, I'm back on. Simon's my first professional surf, like my personal surf coach now.
I'll be the benchmarker. You got to try and catch up.
That's not gonna happen.
We're in the car on the way home, and Benny's like, "So how did you do it? Like, how did you get so much better at surfing?" And I'm like, "Oh, not much. Like, I just surf like 4 or 5 days a week, and then I watch surfing videos every night when I get home, and I listen to surf tutorials, and I started surfing in surf comps, and I started surrounding myself with better surfers and getting some surf coaching and getting some video analysis. Not much."
I was like, oh shit, okay, well, I'm just gonna try and get some life first.
And I'm still shit, but it's getting there. But I'm loving that the surfing season's on as well. Like you got the QS events on over in Indo, Challenger Series on, and the World Surf League. Like I just love following these guys, and it makes you respect these top of the line surfers.
Oh man. Yeah, they're phenomenal. We also had a bit of an impulse on the way down. We both stopped in and bought saunas, barrel saunas for home. So I'm excited about that.
Yeah, I can't wait. Hey, I actually went and had a sauna at a little sauna place last night, and I was just squished in there like a sardine can, sharing with like 4 other people. And I'm like, I can't wait to just have my own sauna in my backyard and just kick back, stretch, unwind, put some meditation music in, and just heal from all the surfing that we do.
Yeah, I'm looking forward to that. I've also had this like sauna fantasy that I'm looking forward to living out.
Oh, yeah.
So, looking forward to that. I pretty much spent $8,000 to make that happen.
Well, hey, bucket list is bucket list. You got to do what you got to do.
So in today's podcast,
Yep.
we wanted to talk about 3 different ways to achieve financial freedom through property. Now, there's a whole lot more than 3, but these are my 3 favorite personally.
Yep.
These are the 3 that in one way or another you and I are both working towards. So let's kick it off with the first one. Like, what is the first idea?
So like the whole intention is to get passive income in the future, because, you know, we believe that the way to become financially free is to generate some form of passive income. So that's where you don't have to work. So I'm not really talking about developing or anything like that, because that requires work. Flipping properties, that requires work. Buying and selling property, that requires work. So it's just more of a passive approach. And, you know, I'm all for the residential property space. Like that's where we value the most real estate, and that's where we're heavily invested in ourselves. So, you know, don't bash us because we're not talking about the 1,000 other ways to get financially free, but you know, this is one. So the first idea is to just go out there and build a property portfolio. Buy 2 really high quality assets, hold them for the long term, pay off your interest, pay off a little bit of debt over time, and then sell them in say 20 or 30 years, depending on where you're starting. You know, if you're starting at 30, maybe you hold it until you're 60. If you're starting at 40, maybe you hold it until you're 60, and then you sell it, and you can actually put that cash, put those profits into a high yielding ETF fund. And
Which an ETF's basically like a Vanguard stock fund.
Yep.
It's sort of like buying the top 500 American, Australian, European, Asian companies or something like that. Like something that gives you a spread which reduces your risk according to Warren Buffett.
And what's the average returns on that? Because I can't remember exactly. What's the average return on capital growth and yields for those ETFs?
Yeah, like obviously it depends on the time frame, but you're looking at 7 to 11% depending on which ETF you're in and for which time frame of the cycle you're in.
Yeah.
So, you know, the FIRE community, who are the people that are all about replacing a base salary as quickly as possible, do their numbers on taking about 4% out per year. Other people do that number taking 7% out per year. But in reality, it's about consistency over the long term. So what you want is a big chunk of cash in the stock market. Some years you're going to make 20%, some years you're going to make minus 20%, other years you're going to get 5%. And it's just choosing a percentage that you feel comfortable pulling out week to week.
And so let's say you had a couple of properties worth $1 million, and that might take some years to build that portfolio depending on where you're starting. But you know, let's say you got $2 million worth of assets, you hold that for 20 years at a 5% compound growth rate, then that portfolio becomes worth $5.3 million. Now, when you sell that, you pay a shitload to tax and the government. So you may end up only with like $3 million that you can put into an ETF fund or something like that. But if you put $3 million into an ETF fund, what are the numbers that I can't read there?
Yeah, my scribble here. I think there's been a parrot in the room writing. But you know, if we had $3 million at 6% a year is what we averaged taking out. On a good year, we took out some more. On an average year, we might not take out any. We're looking at $180,000 per year that we can draw from that $3 million in the market. And then if we had have held that same $2 million worth of property, instead of holding them for 20 years at 5%, we held them for 30. The value of those properties, is that right? Like $8.6 million. So let's say that you sell them for $8.6 million in 30 years time, you end up with $5 million after you pay the government back. You know, $5 million at 6% is $300,000 per year. So
you obviously pay tax on that as well.
Of course you do. So it's like income.
Yeah, but it's quite passive because like with those ETFs, it's not like you're paying property management fees. You're not paying like council rates. You're not maintaining the properties. I don't know how it works with insurance when it comes to stocks, but you know, like it's a lot more passive because you're not having to deal with tenants and property managers and maintenance and things like that.
You know, one of the girls that used to work with us, parents, they were from the Northern Beaches and they'd done over 20 properties throughout their journey. And I remember catching up with her a lot, sort of 5-6 years ago. And at that time, she was basically saying that they were transitioning out of property into exactly this strategy. So what they'd done from the time they were 20 until they were about 60 odd, they had used property as leverage to accumulate a big base of wealth. And then they were transferring that wealth at that right stage of life after talking to their financial advisors and accountants into low-cost index funds because they didn't want to have to renovate, they didn't want maintenance, they didn't want the risk, and they didn't want the cash flow on a $2 million property in Sydney, for example, on the beach, on the Northern Beaches of Sydney, that rents for $1,500 a week is a really, really, really low yield on that money if you're trying to live off it versus, you know, the same $2 million in the stock market getting you 6 or 7% a year.
Exactly.
So that's one idea. I suppose that idea can actually be split too, and we didn't talk about this in the planning, but what Mum's done, which is buying properties and then just selling them. And, you know, she probably should have put the money in the stock market and like lived off the top up. But she's actually just eating the money that she's making from selling them instead.
And she's also like in the current market, she's getting like 4 or 5% interest on that money, that cash in the bank just anyway. So, you know, if you got hundreds of thousands of dollars in there, it does stack up if you do have those high interest rates. It's just that, you know, changes all the time. It's never consistent because the economy is constantly changing, where it's like with those ETFs, they sometimes can be a bit more consistent over time.
Yeah, I mean, they've done better than cash, which is why there's a stock market, right?
Exactly. Exactly. But, you know, that's something that, you know, I think we're interested in just because it can be fatiguing managing tenants. It's a necessary part of the process, but like, you know, it can be challenging managing properties, but you know, it's a good option, but it's not the only option, because, you know, these other ideas, you know, your net worth will probably be better in the long-term future because you're keeping those properties leveraged in the market for a longer period of time. So, you know, next one that we can talk about is like the 3 properties to financial freedom strategy. So this is similar to that first one. It's long-term strategy. We're never going to talk about short-term because getting rich quick just isn't a reality.
I've tried to so many times through property, and I just like should have just bought one good place in Sydney.
Oh my God, the amount of times I've heard it, like, unless you got some crazy business idea that like is so in demand and like you just nail the right timing, it's almost impossible. So I think
like Uber, Airbnb.
Well, yeah, well, you hear those guys in the Shire that started that tech business and they sold it for like $4 billion or something like that. These kids are like 35 years of age. So it's like there is outlier stories, but they're outliers. And I think that's a great book to read, to just from Malcolm Gladwell, to just see how people make decisions and how unique individuals end up in better situations for some sort of reason. It's never really luck. It's just like a combination of factors. But 3 properties of financial freedom. Walk us through that one.
Yeah, so this concept we've talked about in previous podcasts and YouTube videos. For anyone that's interested in that, you can actually go and have a look at those where I do them in whiteboard form or much shorter format if you want to go like really into the nuts and bolts.
Yeah.
But effectively, this strategy is simple. We go by 3 single income, standard bread and butter properties that we all grew up in, everyone listening to this, or you see in Sydney, Melbourne, Perth, Brisbane, Adelaide, like the major regional markets. Now, when I say see them, I mean like they're the types of properties you drive by in the nice streets, like the 3-4 bedroom, single story, double story, like brick and tile, 600 square meter block, like the thing that everyone's wealth in the baby boomer generation was built off.
Like 60 to 70% of the Australian population want this house.
Yeah, and so obviously, you know, you're not going to find that in Sydney or Melbourne right now. You can find it in like parts of Adelaide, Perth and Brisbane still, if you know where to look. But it's, you know, the idea could be something like that. Like you might buy, for example, one in Brisbane. You might buy one in the most undervalued market in Australia right now, a major regional, which is Townsville. You might buy one in Adelaide or Perth. Or you might just, you know, knowing that the Olympics are coming up in Brisbane, do 3 in Brisbane, or you might know Perth, you might do 3 in Perth.
And everyone's at a different stage. Like a common question that I get asked is like, how quickly should I buy these properties? And I'm like, well, how long's a piece of string? You know, it's hard to say because everybody's at a different stage of life. Everybody's got different income and expenses and serviceability constraints. So it's like you do it when you comfortably can, but $1.8 million worth of property in the market, you would hope for them to be renting around $500 plus per week each, so $1,500 per week of income, which is a nice balance.
$75K per year, right?
It's a nice balance as well between like, you know, capital growth and cash flow. You're not buying properties that are ridiculously negatively geared. They're, you know, going to do pretty well.
I liked what you said there because for some people we've worked with, like they bought the first of those 3 properties 9 years ago and haven't taken another step.
Yeah.
Then you've got other people that come in and buy those 3 properties in 6 months because they can afford to and they just want to get it done. And then you've got other people that buy one every 1 or 2 years.
Yeah.
And once they complete that accumulation, that first phase where you buy the properties that will make you free, then they kick back. So you've got 3 600K properties worth 1.8 mil that rent for 75 grand a year in total per year. Now this is cool. Like when you played around with the compound growth calculator, in 20 years time with a 5% gain per year, those 3 properties will be worth 4.7 mil and they'll be renting for 114 a year.
It'll be more than 114 because I rookied it and put in 70,000 at 2.5% over 20 years. So it's probably a little bit closer to 120.
And then in 30 years time, like you said, like I loved what you said before because some people, like let's get real, everybody wants choices and freedom sooner, as quickly as possible. Like I think 99% of people, if they had the choice to choose to do what they're doing today, tomorrow, would choose to be financially free, either doing it or doing something different. So like we get that 20 to 30 year timeframes are long. And that's why we coach our clients on like the 5 different or 6 different ways to pay off debt over a 15-year period or even a 10-year period so that you can do it faster. But let's just say over 30 years.
And like, if we're going to be real, like most people never become financially free at all.
80% of people.
20 to 30 years is better than never. Like better late than never, right?
Yeah, and if you're 30, who do you know that's 50 that's sitting on...
And like the amount of times I've talked to mates and people that have like taken a punt on something to try and get rich quick and then it hasn't worked out, they actually end up taking 2 steps back instead of 2 steps forward. It's just outrageous. So it's just like, play that long game, change your mindset, change your perspective of time, realize that we're going to live a long time. You know, the medical industry is just making leaps and bounds and we're going to be living a hell of a lot longer than our grandparents have or even our parents will. So, you know, find peace in the long term. Like, even once you get financially free, whether it's 20 or 30 years time, it's not going to make you any happier. It's just going to give you more choices to live the life that you want to live and maybe try and figure out how to be content and comfortable within yourself.
100%. Like, that is what we're all working towards. And, you know, in 30 years, those 3 properties could be worth as much as 7.7 mil based on the 5% increase. And the rent, you know, would be probably a little bit above because I'm assuming it was 70K
same. So yeah, that'd be closer to 160.
160K. Like, that's a hell of a place to be. And we know so many people. Like, I was catching up and going for a walk this week with Dave. Dave, on a good year, owns $80,000 to $100,000 as a printer. He's got those 3 properties in place now. He decided to add granny flats to the 3 of them as well. Dave's believes he's going to be completely financially free in about 3 years' time at 45.
I love that.
It's crazy. Like, this guy...
Such a big unit, eh?
Yeah.
I was like, man, are you an ex-footy player or something? Like, he's a unit.
He's a big guy.
Yeah.
And he's the perfect example of someone that came to us with a couple of properties, and we, with his financial advisor and accountant, like, gave him some different ideas, which he sanity checked with them and turned into a formal plan. And then we offloaded some stuff, repositioned his portfolio, and in a 5-year period of time, he's gone from there to like literally being able to like stop work now if he wanted to, but like wants to continue on a bit further. And so this sort of strategy is like so clean. Like, it's very, very, very much in grasp of the people that listen and watch this sort of stuff to do 3 properties in the next 10 years in the right markets.
Most people intend to buy more than 3 properties when they initially start thinking about what they want.
Yeah, like, there's not a person that comes into a call that's not...
5, 10 properties is the norm.
Yeah, obviously then you start thinking about the reality of that.
Yeah, exactly, which is why like less is more.
Yeah, 100%. So the third idea that we've got is sort of same but different, and that's really the 2 properties and 2 granny flats, the financial freedom strategy.
Yeah, so once again, less is more in this circumstance. So you're purchasing less properties, which means less capital growth in the long-term future.
Yeah.
But you're manufacturing more cash flow. You're creating more incomes, which at the end of the day, cash is king when it comes to generating a passive income. So if you can get multiple incomes from the one asset, it'll make the journey of holding those properties a hell of a lot easier because reduces your risk having multiple incomes. It increases your rent because you've got multiple incomes. You get to use tax benefits like depreciation in building a granny flat or building a brand new dual lock. So, you know, it's encompassing a lot of different ideas and strategies in one. But, you know, right now, you can go out there and get a dual income property in Queensland, Western Australia, Adelaide, parts of Victoria, maybe parts of New South Wales, probably not, but for around that 800K a pop. And, you know, let's say you got 2 of them, that's $1.6 million. And, you know, right now they're renting for around $950 to $1,000 per week. To keep these numbers simple, we'll go to $1,000 per week, $2,000 all up, $100,000 over a year. So if you have that $1.6 million property portfolio and that's generating $2,000 per week of income, it puts you in a really nice neutral to positive cash flow position from day one if you're putting down a 20% deposit on the property and the granny flat build. So it's a nice simple portfolio, where these other two ideas, they're probably going to be negatively geared.
That's right.
Because you don't have as much income. So just depends on what you really want throughout that journey, because this is a 20 to 30 year journey. If you want to hold negatively geared properties, you're going to be forced to work in a higher income job to hold those properties. Where with this one, you know, thinking a little bit outside the box and doing something unique, it might bring that freedom forward. Because if you have these properties paying for themselves, then you can go and live your dream a little bit sooner.
I love that. And, you know, ultimately what this is all about is financial security longer term, choices longer term, freedom longer term. But what it brings you back in this moment today is that financial peace concept, where I've done what I needed to do to make sure my long-term future's okay. And now it's a case of like choosing today how I really want to be living. What do I really want to be doing? Who do I want to be spending my time with? And, you know, I think with your idea there, in 20 years' time, did you go through those numbers?
Nah.
Like on that 2 properties, the financial freedom idea. So your 1.6 million bucks in 20 years with a 5% increase puts you at 4.2 million bucks worth of property. In 30 years, 6.9 mil. And in 20 years, the cash flow goes from 100K today to 160K and over 200K in 30 years' time. So again, whether you're looking for like a couple of blue chip properties, the first idea, and then maybe putting it into cash or stocks. The second idea, like 3 simple, affordable properties that you slowly pay off the debt and own outright in the future that makes you wealthy and great cash flow. Or like Simon and I, like you like the idea of everything, which is growth, cash flow, some tax benefits while they're still giving it.
I'm a little bit greedy like that, you know?
Yeah, I want all of it. And I also don't like losing money on my properties week to week. I never have.
Look, I have, because I started at a later date, and, you know, it's a necessary part of my journey in those first years, because I haven't had the income to be able to build those granny flats straight away.
Yeah.
And that's the thing, like, you know, sometimes you gotta go through some hard times in order to have the...
Like, at some point on this journey, unless you're starting off earning $1 million, there's going to be pain.
Yeah.
The pain is saving, the pain is negative gearing, the pain is interest rates going up and burning you a bit.
And like, I was talking to my mate Blakey last night. He's up here from Sydney at the moment. He runs a massive multi-million-dollar a year marketing agency in Sydney, and we were on our way home from the sauna, and you know, we're just talking about like the hard times, because I was telling him about the property and the issues that I've had, and he was telling me about work and some of his clients and some of the issues that he had. By the way, he's almost going to sign up. He's got one of the companies from a core group, which is like the biggest. They run Meriton.
Yeah, I thought they were the big hotel group. Hey?
Everything. So they're doing well, but he's like, you know, Hormozy says it so well. He's like, this is what hard feels like. It's like when you initially set out on this journey, you know there's going to be challenges. You know it's going to be hard. You say that to yourself at the beginning of a journey, whether it's starting to invest in property, invest in stocks, start a business. You know it's going to be hard, and then the hard comes up, and then Hormozy's like, well, this is what hard feels like. You knew that this was going to happen. It's happening.
There's a difference between logical and emotional hard, and people can handle the logic, but as soon as the uncomfortable emotions come up, they want to fight, freeze, or run.
Yeah, and I've ran heaps of times in the past, and you know, I try not to run too far. I just try and run a little bit, and then I'll turn around and face it, and just look at that image in the mirror and just be like, yeah, that's uncomfortable, but you know, I'm going to go through this and come through the other side feeling a hell of a lot better about yourself.
That's beautiful, man. Like it's not easy to sit in the uncomfort of like trying to create something, because this is what normal looks like, right? Normal looks like one of two things: working till you're 69, 70 and being financially free, and working till you're 69 or 70 and being on the pension. That's what it looks like without you going, I don't fucking want that, and I'm going to choose to do something different. And your choice is crypto, stocks, business, property. Choose your pain, and then drink your poison. Like literally, it's choose your pain and then obsess about that one thing.
You know, I got this, like, I stopped buying athletic greens, so we're not going to promote them on the podcast. Nah. But I swapped it for another one that's like less than half the price, but it just tastes shit in comparison. But I'm like, every morning I drink my green drink and it tastes like shit. And then I have my Camu a lot of the time as well, which is like the highest vitamin C you can get.
Nice.
And they both taste like shit. And I'm just drinking them like, well, this is health. You got to cop it. If you don't want to get sick and feel shit, you got to drink this every day, baby. And it's just accepting the fact that there is shit parts about life, and you know, the hard things are better at the end of the day.
Yeah, like it's so funny, right? Because every sports person, musician, actor, artist, politician, movie, documentary that we all love, everything that trends like shows that full range of like the vision becomes the hustle, becomes the broken, becomes the rebuild, becomes the broken, becomes the rebuild. It's the hero's journey. And it's like that.
We love that.
We love it because it's innate to who we are, and we can't grow without pain.
Yeah, it's just our pain is a little bit different to like, you know, those people that we put on a pedestal. And it's funny, it's like, as you said, you got to choose your poison, you got to choose your pain. Like, I was talking to Tay this morning, and you know, she was saying that like she's just sold her car and she's buying a new one because we got the baby on the way, and her old one wouldn't fit the pram and a baby seat in it.
I'll just say something about that. Like, I drove out of the hospital with my first bub Summer in a $1,000 two-door Toyota Echo with a hired baby seat from the Ambos because we couldn't afford one. So like, you could fit the pram in the back, Tay, but I know what you're saying. Like, whatever you have to justify
we're in a nice.
Stuff.
We're not struggling that much, so we do have those luxuries of life. But she's talking to her friend, and like Tay doesn't open up too much about where we are with her community because, you know, everybody's at a different stage of life. But one of her colleagues was complaining and being like, "Fuck, you know, like I'm driving like a $4,000 beat up old car, like." We're renting, we've got a baby, and you know, we just don't know how we're ever going to get into the property market." And she's like, "I'm just so bad with money, like I don't know how to do it, I don't know how to figure it out." And I'm like, well, have you sort of told her to like pick up the Barefoot Investor, or like, you know, go sit down with an accountant or a financial planner to try and like figure these things out? And she's like, yeah. I'm like, what's her response? She's like, "Oh, I can't do that. It's not for me." And it's just like, some people get so attached to their identity, thinking that this is who I am and I can't change. But it's just like, there's got to be a desire to get better. There's got to be a desire to improve. There's got to be a willingness to go through the mud, like Simon Sinek says, like go through those hard times to come through the other side and be a better version of yourself. And it's like, this girl is completely convinced herself that this is her reality. This is how she's going to live forever, and she's never going to get an opportunity to go and live an amazing life filled with choices and freedom. But it's like, I know she can because we've all done it, and I've seen so many people do it. And it's just like, even if you don't like reading, even if you don't like learning about finances, it's a necessary part of the world that we live in. So like, you've got to be disciplined and figure it out.
You know, I remember when you first started at the business, you were like, I think I've read like one book before you started. You've listened to hundreds of books now and read hundreds of books in
hundreds.
Like, you know, that was a choice. Like there's a choice point all the time. And I've learned
to love it.
Yeah, now you enjoy it.
I hate reading. Now I love it.
Yeah, and so I think there's two things. Like, if I think about my own journey of what got me to that point to take action, and then what got me to that point to go beyond just one home, which most people do, or two. And so I think there were two things. One, the pain of my parents being super, super broke when we were little, and hearing them argue every single night about money growing up, and not being able to have like those Billabong shorts, which like I really wanted because I wanted to fit in.
You're a surfer, you love that lifestyle.
And we got all that later. So like, I also saw my dad, everyone was struggling at that time in the late 80s, early 90s, because fucking interest rates were like 16 to 20%. So it wasn't mum and dad. This is the experience of everyone where we grew up was identical.
Kind of similar at the moment.
Yeah, it's tough right now. for a lot of families in Australia, and it's not dissimilar to that time. And it's creating a lot of pressure and cracks in society and people's households. But there was a pain of like, I made a commitment young. I'm not going to like, this isn't how it's going to be for me. And then I also, and that the pain doesn't drive me very much. It drives a lot of other people. Like they say for the average person, pain is a much, much bigger motivator and has it's 9 times more powerful, according to Harvard, like a negative emotion than a positive one to create behavior change. But for me, I'm lucky that like I live in the clouds half the time, and I can completely clearly see a future. And so there's the pain that I was running away from and wanting to like fill a hole within myself, become worthy, move away from being broke, to I want to be stable, I want to be free, I want choices, to, oh my gosh, I'm missing time away in the present moment for my children. Like when I had the kids, like I already had this vision of like, I could see myself wealthy, successful, financially free, fucking young in life. Like I caught up with a friend of ours in the surf. I've said this to you before, and he's like, could you see this when we were like, all the boys were living in the house together at uni? I'm like, fuck yeah, I could see it. How do you make something happen that you can't see? It didn't just appear out of thin air. Like it appeared out of like busting my ass for 15 years.
Longer than that though as well, because I remember even when you're at school, like your discipline with study and homework and assignments and tests, like your entrepreneurial mind and, the lemonade stalls, the t-shirt businesses, like all of these different things that you've tried over the years, running papers, like everything, like it's not been 15 years, it's been a lifetime.
Yeah, and so, there was the pain of the past, there was a vision of the future, which was exciting. And I really encourage everybody who's listening to this that doesn't have a 1-year goal and a 15-year vision to like just write that down tonight or think about it this weekend. And then it went from the future and the past, which is where I spent most of my life living in the future, and that's why I struggled with anxiety for a lot of my life, to I'm actually in the present and I'm missing time. Like when you're trading time as a parent away from your children to half-ass your life, no. Like for me, it was just like, nah, I'm not doing it. And
I won't accept it.
I won't accept it. And it's like, and I did it for a long time too. But they got to a point where my daughter was about 5 or 6, and you saw that change period when I'm like, I'm a fraction of the person that I see myself as and know better stuff. We really got our shit together in the business. And I encourage people, especially the ones with kids on the way or with families, to just be like, this little dude that you're trading 60 hours a week away at work from to do what? Like to lose 50% of it in tax? Like, man, invest, get that time back, hang with that person more.
100%, man.
At some point, rant over, but
I love it though. And it's just like, you got to choose, like you got to make it happen at the end of the day. And it's like so many people, and some of the things that I've suffered from that we've talked about is like imposter syndrome, not feeling worthy enough for what I have. And like that holds a lot of people back from taking action as well. So it's just like believing that you are worthy, believing that you are good enough, believing that you do deserve whatever you choose to have in life, but then putting that plan in place and making actionable or taking actionable steps that are leading you towards that, whether it be picking up the book and reading the book, whether it be setting up an automated payment so that you're paying yourself first and saving some money to buy that first property, or whether it's like sitting down and going, well, what do I really want my life to look like in my 40s, 50s or 60s? And reverse engineering that back to what needs to happen next in order to get one step closer to that goal in the future. And I've had those fears of like, having the big lofty goal and not knowing how to make it happen. And it's just like, just figure out the next step and take that step. Like break it down into actionable mini goals that you can chip away at and achieve now, today, and then over time it'll inevitably happen. And what we've both realized is like, it often ends up being better than you expect.
Much better. Much better. Like, I've been watching a lot of soccer docos at the moment, and there's a really good one called Captains of the World, which is the World Cup one from the 2022 World Cup. And there's another one that just came out this week, or I've seen it this week, which is the Manchester United treble one.
Cool.
And what I've realized about, real high performance, you cannot be a high performing, functioning, present person and think about what's next. And all of them are just obsessed with the next step, the next game. And it's like, what end of year?
And I was saying that on the way down to the surf thing, like Italo Ferreira is one of the best surfers in the world from Brazil. And he won a heat in Chopu in Tahiti, and he was getting interviewed by this guy, and the guy's like, well, you're making leaps and bounds. You're probably going to end up in the final 5. Like, what are your thoughts on the end of the year? And he's like, man, I'm just thinking about my next barrel. It's like, I just want to get back out there and get a fat barrel. And like, that's what I'm thinking about right now. I'm not thinking about that. He's like, I've got plenty of time to think about the future, but that's not right now. Right now, all I need to think about is getting another massive barrel.
And you know what? We always talk about this, like, there's always 5 surfers a year that are locked in, but the top 3 are always the ones that have that response.
Yeah.
Like, it's always the one that's doing the extra training, the mindset stuff. And when someone's like trying to drag them out of the moment, they're like, nah. I'm here.
Yeah.
This is what matters. And that might end up putting him in title position later on this year. Like, that's winning mentality.
It is. It really is. But I love it. Like, I think everybody is capable to make this happen, especially in Australia.
Who can't buy 2 properties in the next 20 years? Like, come on.
Exactly. Just like expand your time horizon and it will all come together. And if you're trying to do it too quickly, then the house of cards might come crumbling down. So just give yourself more time and it will work out. But let's jump into some positive news now, because there was a really, really nice piece of information that came out from the Commonwealth Bank of Australia recently.
Yeah, so thank you, Ray, again, mate. Legend. The reports that you flick us through are phenomenal.
We probably shouldn't name drop that.
No, Ray's cool. He's all good. I'm not entirely
I don't want to stop getting them.
Yeah. But no, he sent me a report. So basically, the government lent a whole bunch of money, as we know, and it created a monster asset bubble boom.
They didn't lend it, they just gave it away.
They just gave all this, they printed and then they gave it globally, and everything went up, stocks, properties, crypto, blah, blah, blah. And then they went, we accidentally overreacted, pull on the brake.
Just a quick one on that as well. Like, a lot of people think when we give away this money, it just ends up getting spent on stuff, cigarettes, booze, gambling, clothes, eating out, etc. And it's like,
it goes into assets.
It first goes to those things, but then the people who are owning those businesses, that are creating those products, that are selling those products, they're then spending it on assets. They're then expanding their businesses, buying a new commercial joint, or they're the ones that are upgrading their home, or they're the ones that are going out and investing it in property. So you can't just look at one step of the economy. You got to look at it like how money moves through an economy over time.
Yeah.
It's like, that's why we didn't see a huge asset boom in 2020. It took until 2021 because people needed to spend the money first on the stuff, and then the people who sell that stuff to the population, then they start taking action.
There's actually a book up here that's come out recently behind us. Sorry, I'm pointing to it where people are listening on a podcast. But for those of you watching on YouTube, The Secret Wealth Advantage.
Oh, yeah.
Highly, highly, highly recommend that. But it talks about how the money goes from clothes to business owners to assets, and those assets go up and then everyone else comes in after that, and a whole bunch of other stuff. But, basically, they started to put interest rates up because it's one of the 5 levers that Ray Dalio talks about that you can pull to slow or speed up an economy. And this is the first report where basically CBA was like, the economy has now flatlined. And if they continue to hold rates at this level, we're going to end up in a technical recession, which they don't want. They just wanted to get inflation under control back to a normal range of sub 2.5%.
It's always what they've said.
And so if they've done enough to now do that, which I believe they have, because a lot of people are hurting, myself included. Like my position is 150 grand a year worse now than it was 3 years ago, 2 years ago.
And the data's always delayed a little bit as well, because it doesn't come through immediately.
Yeah, it's super delayed, and there's always things they're waiting for. And so what's happened, the positive news out of all of that, I suppose, is they've done what they needed to do now, and they'll probably want to maintain that for a couple of months. But the most likely scenario now is at some point between now and the end of 2025, rates are going to come down. CBA has been forecasting for over a year now that when that happens, from the top of the rate cycle to the bottom, there'll be almost a 1.5% drop. So if you're on a 6.5%, they reckon you'll be sitting sub 5% within a year and a half from now.
Can't wait.
Which is crazy, especially as an investor, because we know what that does. Like when CBA, a 1% rate drop generally results in a 15% increase in prices Australia-wide over the year and a half, 2 years, that period. So it's not just great for the average household to live better, but it's amazing for investors
kind of
who own
skimmed
property.
over that so quickly, but that's such a massive gold nugget.
Yeah, I don't like sharing that one too much because almost no one knows about that.
No, exactly. And the funny thing is as well, like when we're looking at some of Phil's stuff where he looked at 70 years of interest rates, and what he realised in Australia, there'd been 11 interest rate rising cycles over the last 70 years, and 10 of those 11 interest rate rising cycles, property values actually went up, and then this rate rising cycle has proven the same thing over the entirety of it as well. So, interest rates going up, going down, there's more to it than just which direction they're going.
I love that. Now, another little segment we love is the gold nugget of the week. What is the gold nugget this week?
So this one's a bit of an old one that we keep hounding home, but it's just at a time that's really important. So, CoreLogic did this study where they looked at capital growth rates from 1992 through to 2022, a 30-year sample size. And what that indicated is the average house in a capital city went up 453% over that 30-year period. Mm-hmm. Whereas units went up 303%. Units in major metro markets went up 303%. So 140% different over the 30-year period. And, a lot of people right now with the higher interest rates, they're looking for more cash flow. They're looking for more affordable assets. So they're starting to focus more attention on units.
I'm watching that in CoreLogic at the moment. The unit prices are going up faster only because they're affordable, but you've got to think long-term versus like the next year or two, what's happening with them.
And you've got to look at it from a net perspective as well, because yes, looking at the gross numbers, the rental yield of a unit looks better than a house. But once you factor in the body corporate fees and all of the other holding costs with a unit, it's not that much better. And to lose so much capital growth in the future for a slightly better cash flow position is just...
It's crazy.
It's crazy. So, I know houses are expensive in a lot of the capital cities, but there's still some chronically undervalued locations throughout the country that you can purchase houses that are going to have a much higher upside potential in the future.
And I will put an asterisk on that because I have bought units before. Many people listening to this will own them or will buy them because they're affordable and they want to do something. So if you are, my criteria for a unit is small block, like 4-pack to 16-pack maximum, 80 square meters internal if you can, with at least 2 bedrooms, in a unique position with something like either very close to the beach or very close to the city. Like, I don't hate units, and there's many examples of units in Sydney that have massively outperformed houses in every other place in Australia in the last 20 years. It's more just for the average person, just go with houses. Like, you will end up exponentially better off. And the difference is, like, imagine having $1 million in stocks, and you could, like, with this information, go and buy one stock that's going to give you 10% a year for the rest of your life, or one stock that's going to give you 6%, and you knowingly go put it in the 6%, or even under that, you've got $1 million in cash now. You can go get it at 1.5% from the bank interest they'll pay you a month, or another bank's offering you 6%, and you'd knowingly choose to go put it in the 1.5%. Like, you wouldn't do it in stocks, you wouldn't do it in cash, So why would you do it in property?
Exactly. Like with property, it's all tied to the land values. Like that's what's going to go up over time, the land itself, not what's sitting on top of it. So if you can't afford a house, try for a townhouse. You know, there's great townhouse options, duplexes, villas, bungalows, whatever it might be.
Bungalow.
Just try and avoid. And, you know, I would like avoid at all costs personally. And I'd recommend all of our clients and all of my friends and all of my family to avoid at all costs high-rise apartment buildings, off-the-plan units. You know, I would even add to the ideal criteria a undercover parking space, or at least just an allocated parking space, and even a little balcony as well, a little bit of outdoor entertaining area, because those units will create more owner-occupier appeal. If you're in a small complex, you got 2 bedrooms, 80 square meters, you've got a little car park underneath, you've got a little balcony off the side or something like that. Maybe try and get it north facing. We're adding a lot of things on there, but like the difference between buying one versus the other might be $20,000 to $50,000. So try and spend the extra 20 to 50 to get the slightly bigger north facing apartment that has a few little additions.
With the water view over Sydney Harbour Bridge, like why not?
Yeah, they only cost like $4 million.
What's the last thing we wanted to talk about in the podcast? We want to talk about the teacher, like
a teachable moment.
A teachable moment.
I don't even know where this came from, but you know, that's what we're calling it at the moment. But
it's the lesson of the week, really.
That's right. It's just little things that I guess like we think about or meditate on, or you know, have heard recently, or of, you know, whatever it might be. So what's your one?
I was actually watching this little like a little reel on Instagram the other day, and it was this young guy that went up and interviewed this old dude who was 95, and he said, basically, what have you learnt from life? And he had this quote in it, which I'm just going to grab up from my phone because I don't have it memorized. And when I say the other day, it was literally yesterday. But he said halfway through, he's like, try to be as positive as you can, because tomorrow is going to be a better day unless you make it a worse one. Mm-hmm. Now, what was interesting to me about that is he's 95 and he's had a lot of great days and bad days, right?
He went through World War II.
Yeah, probably.
Absolutely.
And he, you know, in terms of like that concept, that the mind is constantly like the shadow self inside us, or the fear self, like the guy that wants to keep us in the cave to protect us from like the evil dude in the next village. Like that reptile part of the brain is constantly wanting us to be fearful of tomorrow. And it's like tomorrow's got enough worries for itself. Like just take care of today. Like that's biblical stuff. Like the Tao says the same thing. Like, do you have the patience to wait for the muddy water to clear? And it's like just this idea of like, if we could spend our whole lives, and I've seen people in our family even do this, fretting about tomorrow, like fretting about what it could look like. But over the course of his life, like tomorrow is going to be a better day unless you make it a worse one. And I was just like, I've never ever heard anyone say that.
Simple thing. It
was just so big for me, because it's like, I don't want to be the dude that accidentally makes my tomorrows worse when 90% of the time your life is conspiring for you and it's going to get better.
I love that. Hey, that's so nice. You know, my one is something that I wrote down in a bit of a moment of stress or anxiety. And it's, don't make long-term decisions based on short-term circumstances. So like a lot of the time something bad will happen and we catastrophize that situation, and we try and change things and try and control things to make it better, thinking that that's going to help. But it doesn't. Just give it some time. Let the muddy water settle and clear itself, and just move on. But I find so many people self-sabotage and create really uncomfortable situations for themselves because they try and control things or change things that just need to be left for a little bit. Just need to give it some time. So it's like,
take a breath, like sleep on it. These are things that people have been saying for thousands of years, right?
Yeah, exactly. So just don't make long-term decisions based on short-term circumstances, good nor bad. You know, like sometimes when you're feeling good, you might overdo it a little bit, or sometimes when you're feeling bad, you might underdo it or catastrophize. So Yeah, that's something that I just remind myself of any time where things aren't going my way and I'm in the mud, and it's just like, you know, that really awesome round table where you got all of the famous actors and who's the Tom Hanks. He goes, you know, one of his favorite sayings is, "This too shall pass."
Yeah, this too shall pass.
And it's just like letting it go, just giving things some time, and it will all sort itself out at the end of the day.
Man, I love it. I've really enjoyed this, Poddy, to be honest with you, because there isn't one way to get to financial freedom. And the further I go down this rabbit hole, the more I recognize that. Like, for some people, the best thing they could do is develop. For other people, the best they could do is Airbnb. For others, it's houses and granny flats. For others, it's flipping and moving around. For others, it's buying and holding long term. For others, it's stocks, crypto, currency, business, a high paying job, like a career that they love. Just saving money might be the best thing for some other people. And so just the recognition that there isn't one way to do this, but what has changed mine and Simon's life is a recognition that nothing allows you to safely leverage like property does. Nothing is owned by more owner-occupiers that aren't playing the market than property and is less liquid.
/ more millionaires and billionaires.
Yeah, and if you look at like the allocation of like the wealthiest people in the world, every single one of them's got exposure to property for one reason. Like, it is done exceptionally well globally for hundreds of years straight, because people are always going to live and want to live in prime positions, well located to high paying jobs and the lifestyles they want to lead. And as Australia goes from 20 something million to 40 or 60 million.
Michael Matusik just did an article the other day where he believes that by, I think it was 2044, so like 20 years from now, the population will be in the 40 millions.
Yeah, that's what the Australian government sort of give or take.
Yeah.
It's crazy. And so just the recognition that
it's doubling.
High value locations like Sydney, Melbourne, Brisbane, by that point, there'll be 10 in Sydney, 10 million, there'll be 10 million in Melbourne, in southeast Queensland, there'll be 7.5, 5 million in Brisbane at least. Like, these are important things to know when you just start thinking about allocation of assets. And so it's like, if I do want some property and I'm only going to do a few, then East Coast cities, East Coast regional markets, if possible, close to the city, close to the beach, houses in quiet streets with big blocks of land that aren't going to give you too much pain over the next 15 years. And if you try and put those things in place, you'll do exponentially better than someone who's not consuming this stuff, because this might be becoming really comfortable for the people that listen to this. And then the people that listen to this that end up booking strategy sessions with us, and they get more ideas from that session. And then the few people a week from all of those people every week that reach out that we actually choose to work with long term, get the next level. And it's like, you can be listening and applying yourself, you can be listening, booking something with us and learning further, or you can be working with us and getting 15 years of your future back that you would never have, because we will speed it up by that much. And it's exciting, man.
It really is. I really think it is. But thanks for persevering through this one, guys. If you've made it to this far through the podcast, please subscribe. Please share this video with someone. Please give us a 5-star review. We don't often ask for much. We just try and share the information that we have, and all we ask is to support us so we can continue doing these things and continue bringing these podcasts and videos, so that we get to have a bit of a yarn about the things that we enjoy right now. But thank you so much for listening. We are so grateful to share this stuff with you, and until next week.
Woo! That's a wrap. That's a wrap.
Have a swim. Yeah. Oh, sweaty. So sweaty. Oh, that's good. That's so nice.